Ethereum could realistically hit $700,000 per ETH. Yes, you heard that right, $700,000 per ETH. First, we had Cathie Wood predicting a $180,000 Ethereum, then Tom Lee predicting a $144,000 Ethereum. But to top it all off, we now have a long-term target of a $700,000 Ethereum. It sounds wild at first, but that prediction comes from Wall Street legend Vivek Raman, the co-founder and CEO of Etherealize. Here's his prediction in his own words.
How do you put the pieces together and say this is where ETH can go?
I think we are in the process of re-rating it to become global infrastructure. And so in our digital oil piece, I mean, when ETH is the infrastructure that the whole world, both financial and non-financial, all businesses settle on, and we put $700,000 as a target.
If you don't know who Vivek Raman is, he spent over 10 years on Wall Street working as a fixed income and credit trader at top firms including Morgan Stanley, UBS, and Deutsche Bank. However, the more Vivek learned about Ethereum, the more he realized it was going to be the future of finance. In 2024, Vivek launched Etherealize with backing from the Ethereum Foundation and Vitalik Buterin, positioning it as the bridge between traditional finance and Ethereum. His goal is to educate, enable, and onboard the biggest institutional and corporate players to Ethereum. So when Vivek says Ethereum could go to $700,000 per ETH, it's not a random prediction. He's dedicated his whole life to Ethereum and is now working with the biggest players in the space. In this video, we're going to break down why a $700,000 Ethereum is not a random moonshot prediction, but how it could actually happen. But before we dive in, only a small percentage of our viewers are actually subscribed to the channel. If you enjoy the channel, consider subscribing. It's completely free, helps us put out better and better content for you, and you can always change your mind later. Now let's jump in. First, you need to know who Vivek Raman really is. He's not some random crypto influencer chasing views. He's a Wall Street insider who spent over a decade in the engine room of the global financial system, the place where trillions of dollars actually move every single day. He's seen exactly how money flows, where the process breaks, and which risks keep billion-dollar institutions awake at night. When Vivek discovered Ethereum, he didn't just throw some cash at it and start posting price predictions. He went all in on translating Ethereum into a language banks, asset managers, and policymakers could understand. That's why he created Etherealize. Etherealize is built to merge two worlds: on-chain reality and macroeconomic reality. On the blockchain side, they track the hard numbers, staking activity, Ethereum fee burn, validator economics, roll-up settlement volumes, and exactly where liquid supply is sitting. On the macro side, they monitor money supply, real interest rates, ETF inflows, how corporate treasuries are behaving, and which market participants are sensitive to price versus those who will buy no matter what. Then they overlay adoption trends, which banks are tokenizing assets, where stablecoins are getting regulatory green lights, and how global rules are shifting from uncertainty to clear frameworks. That's the lens behind Vivek's predictions. When it comes to predictions, Vivek would know better than most. Before we talk about a $700,000 ETH, let's get one thing clear. A $700,000 Ethereum is Vivek's long-term target. His nearer-term target, an $80,000 Ethereum.
A lot of things have to happen to get there, but I think a $10 trillion asset is not out of question for global infrastructure where many new economies are building on, and that means an 80K ETH. So I think we've almost been in this PTSD thing where ETH has been performing so badly price-wise for so long that people just don't dream big anymore. You're like, oh, we were trying to get to 10K last cycle, and then there were a lot of market forces that didn't, and then FTX blew up and everything. So I don't know. I think we have to dream a lot bigger. I think we're building the infrastructure for the whole global economy, and that's a $10 trillion asset. So higher, my target's higher than anyone else's, but that
80K is definitely up there.
I mean, 706K is really up there too. But no, I just think that we're gonna reprice. It will be Bitcoin, then it was Bitcoin, then it will be Bitcoin and ETH, and I think more and more it's gonna become, hey, why don't we just do ETH? And you're seeing that Bitcoin mining companies are switching to become ETH treasury companies. Everyone we talk to about these treasury assets, they're like, oh, we know why Bitcoin is backing some of them, but now they're starting to say, wait, you can do more with ETH. So why would this not be a better treasury asset? And That's where all this begins. So I'm excited to let that narrative play out.
An $80,000 Ethereum is a calculated waypoint in Vivek's model. It's the point where Ethereum has completed its institutional onboarding phase but hasn't yet absorbed its entire addressable market. It's the repricing that happens when the market finally accepts Ethereum as a core income-generating institutional asset, and that repricing is underway right now. Vivek isn't pulling these predictions from thin air. He is basing a near-term $80,000 Ethereum on four main forces that will drive the Ethereum price higher. The first force that will push Ethereum higher is the Ethereum ETFs. The spot Ethereum ETFs should not be underestimated. They are the cleanest, most regulated pipeline path between trillions of dollars in traditional portfolios and Ethereum. Here's the thing, pension funds, insurers, endowments, and corporate treasuries were never going to open a MetaMask wallet. They were never going to own their own cold storage systems or buy Ethereum straight out. They needed something they could buy inside the same brokerage account they already use for Apple stock or treasury bills. The spot Ethereum ETFs solves that problem instantly. We've already seen what this did for Bitcoin. In just months, US spot Bitcoin ETFs have absorbed hundreds of thousands of BTC, hundreds of billions in inflows from buyers who were simply locked out before. Ethereum now has the same doorway with a twist that makes it even more compelling. ETH pays a native yield. If you hold Ethereum, stake it, you earn even more ETH for securing the network. For institutions looking for both exposure and income, this is a product they already understand. It's like buying a blue chip stock that also pays a healthy dividend, except the dividend comes in the form of more of the asset you want to own. As this narrative continues to unfold, we are going to see more and more inflows into the Ethereum ETFs, something we are already starting to see with volume exploding over the last month. The other side of the equation is supply, and Ethereum's supply dynamics have never been tighter. To put it simply, Ethereum is heading to a straight-up supply shock. Since the merge in 2022, ETH issuance fell off a cliff compared to the old mining era. On busy days, the network actually burns more ETH in transaction fees than it issues to validators. That's visible on-chain. The supply chart literally steps down when activity spikes. At the same time, a massive share of ETH is simply not available for sale. Over 35 million ETH, roughly 30% of the entire supply is staked. A big chunk more sits locked in smart contracts, DeFi protocols, corporate treasuries, or with long-term holders who aren't touching it. That leaves exchange balances at multi-year lows, the lowest supply we have ever seen, and you add new demand on top of it, especially price-insensitive demand. The price does the heavy lifting. This is basic economics. The third force that will push Ethereum higher is the arrival of Ethereum treasury companies. In the last cycle, the capital flows into Ethereum came mostly from retail traders and crypto-native funds. That's not what's happening now. This time, we're seeing public companies and billion-dollar funds executing a treasury accumulation playbook for Ethereum, the same playbook that drove Bitcoin's breakout to over 100,000. Tom Lee, the man who predicted Bitcoin's bull run to over $100,000, has now shifted his spotlight to Ethereum. Through his treasury company, Bitmine, he's buying billions of Ethereum in a matter of weeks, with a stated goal of locking down over 5% of the total supply. And he's not alone. Joe Lubin, an Ethereum co-founder, is doing the same thing with his company SharpLink. He has turned SharpLink into a major public Ethereum treasury vehicle. Cathie Wood has put serious capital behind this race. Legendary investors like Stanley Druckenmiller and Bill Miller have also taken positions in the companies executing it. These are not weekend swing traders. These are huge players with multi-year time horizons who understand what happens when you front-run a structural repricing, and when they buy, they don't sell on a 10% dip. They are taking supply off the market for years. The final force that will push Ethereum higher is about what it actually does. Right now, stablecoins are breaking out of the crypto bubble. They're being used for payroll, payments, and cross-border transfers by companies and now even governments, and the large majority of stablecoins run on Ethereum. At the same time, the biggest names in finance are starting to put real assets on-chain. We're talking about tokenized funds, tokenized bonds, and even tokenized US treasuries. This isn't theory anymore. Major banks and asset managers are already testing, settling actual trades on Ethereum. And here's why that matters. Every time those transactions happen, they pay Ethereum network fees. Those fees burn ETH. burned ETH is gone forever. That means less supply. When you've got rising demand meeting falling supply, prices tend to go one way upwards. It's a flywheel that feeds itself. Real-world use cases bring more transactions burn more ETH. Less Ethereum supply available means higher prices bring more attention. More attention brings even more use cases, and that's why as these use cases hit the mainstream, they put a constant upward pressure on Ethereum's price. When you put these four forces together, an $80,000 Ethereum stops sounding like a miracle and starts looking like simple market math. The ETFs open the demand faucet, Ethereum treasuries and funds keep buying Ethereum and locking it up through staking, exchange balances stay at rock bottom levels, and increased Ethereum network activity keeps the burn rate high. With demand surging and supply this tight, the market doesn't have many options, the price has to move up. We've seen this recipe before. The difference is that this time the setup is stronger, the buyers are bigger, and the supply is thinner. In Vivek's framework, $80,000 is where the ETF era matures and Ethereum is fully recognized as a core institutional asset. But that's just the beginning, because once Ethereum is in every major portfolio, the real game, the one that takes Ethereum towards $700,000, starts. It's worth pausing on Ethereum's supply mechanics because they're the core of how Ethereum's price could quickly re-rate. Right now, a huge portion of Ethereum's supply is staked, earning yield and effectively taken out of circulation. Another huge share is locked inside protocols, DeFi, and corporate treasuries. It's part of the Ethereum ecosystem and is not actively traded. What's left is just the liquid Ethereum sitting on exchanges, and that number is now at historic lows. In previous cycles, there was plenty of tradable supply to absorb new demand. This time around, there isn't, and we're seeing more demand than ever before. Now, for the big number, a $700,000 Ethereum, this isn't a wild guess. It's based on a long-term view of Ethereum becoming the main settlement layer for a huge chunk of the world's wealth. Think of how the internet started. At first, it was just for sending messages. Over time, it rewired the entire economy. Ethereum is trying to do the same thing, but for moving money, assets, and payments. Right now, the total value of global assets, stocks, bonds, real estate, commodities, and all the financial products built on top is in the hundreds of trillions of dollars. If even a small slice of that moves onto public blockchain rails over the next decade, you're talking tens of trillions of dollars being transacted and stored on-chain. Those transactions need a neutral, secure, always-on network. The most likely candidate is Ethereum. Every time value moves on Ethereum, it generates fees. Those fees burn ETH, permanently reducing supply. At the same time, Ethereum is staked by validators to secure the network, further locking up coins. Over the years, this combination steadily shrinks the amount of Ethereum actually available for sale. If supply drops under 90 million coins while the network is valued at $60 to $80 trillion, the math works out to around $700,000 per ETH. But there's another angle. Ethereum isn't just a tech investment, it has monetary qualities. You need it to use the network, and it's also productive because staking earns you a yield. Very few assets in history have offered both at the same time. When markets realize they're dealing with something that's part reserve currency and part technology toll road, valuations tend to reprice sharply, not gradually. Of course, there are risks. Ethereum needs to keep scaling to handle more demand. Other blockchains will try to win market share. Regulations can change, and crypto cycles can overshoot and correct hard. But Ethereum's roadmap is designed to adapt, adding new technology without losing security. Regulation is slowly moving toward more clarity, and the investor base is shifting from fast-moving traders to long-term institutions like ETFs, corporate treasuries, pensions, and banks. This is the foundation of the $700,000 thesis. It's not a dream scenario, but the logical endgame if Ethereum truly becomes the financial backbone of the digital age. Here's the Ethereum price prediction in a nutshell. Vivek's Ethereum roadmap has two stages. In the medium term, Ethereum ETF demand ramps up. Companies holding Ethereum in their treasuries increases. We see more coins getting staked, and the constant burn from transaction fees could drive Ethereum toward $80,000. That's a move you can explain with real numbers, a supply shock that's already visible on chain. Long term, if Ethereum becomes the go-to settlement layer for a meaningful share of the world's financial system, $700,000 $100,000 isn't a fantasy, it's the result you get when powerful network effects meet a shrinking supply and long-term buyers who aren't looking to sell at the first sign of profit. No one can give you a date for either milestone. What you can do is watch for the signals. Are ETFs steadily pulling in new money? Is the amount of staked Ethereum climbing? Are exchange balances staying low? Are banks and payment companies rolling out real products on Ethereum? Are regulators moving from fear toward clear rules? These are the signs that either confirm or challenge this roadmap. Now, if you don't want to spend hours digging through charts and headlines yourself, I make it simple. Every morning, I send out a free 5-minute email called the Crypto Nutshell. It breaks down the metrics that actually move the market, the on-chain data that signals supply squeezes, and the institutional news that matters. It's fast, clear, and built to keep you ahead of the crowd. Click the first link in the description, drop in your email, and you'll get tomorrow's issue in your inbox. Thanks for watching. If this gave you a clearer view of Ethereum's path, hit like so more people see it, leave your thoughts in the comments, and subscribe. We've got a lot more to cover this year. I'll see you in the next one, and as always, all the best.